Let me be blunt with you right now, because nobody else in your life has the spine to say this to your face. There is a $29 trillion race happening on this planet as I speak. It is being run by central banks, sovereign wealth funds, and the most powerful governments on earth. And you, sitting there with your 401 kilobits and your index fund and your pathetic little savings account denominated entirely in US dollars, you are not even in the stadium. You are not watching from the parking lot. You do not even know the race exists. And that ignorance, that comfortable, television-induced financial stupidity is going to cost you everything. Not some of it, everything. The purchasing power of your savings, the real value of your retirement, the financial security you believe you have built. It is being systematically dismantled while you argue about which political party is going to save you. Nobody is coming to save you. That is the first truth. Now wake up and listen carefully, because I'm only going to say this once. If what I just said made your stomach drop, good. That means your instincts are not completely dead yet. Hit that subscribe button right now, not later. Now, the intelligence I am sharing in this channel is the same caliber of macro analysis that institutions pay 6 figures annually to access, and you are getting it absolutely free. Every week I break down the moves that the smart money is making before the financial press even understands what happened. One subscription, 0 cost, and it might be the single most valuable financial decision you make this year. Subscribe now. On the morning of February 28, 2022, a phone rang somewhere inside a Moscow government building, and the person who answered that call received the most important financial education of the 21st century. Russia's central bank had just learned that $300 billion of its foreign currency reserves, $300 billion that it had spent 2 full decades carefully accumulating, was simply gone. Not stolen, not misplaced, not seized through any legal process that took months of courts and arguments and appeals, turned off like a light switch. One phone call from Washington to a network of correspondent banks and custodians, and $300 billion ceased to function as money. It became numbers on a screen that nobody was allowed to touch. And here is what I want you to understand about that moment. Because most people heard that news and thought it was about Russia, thought it was about geopolitics, thought it was about punishment for invading Ukraine. Those people completely missed the point, because the people who understood the actual lesson were sitting in finance, ministries and central bank boardrooms in Riyadh and Warsaw and New Delhi and Beijing and Brasilia and Jakarta. And every single one of those people in every single one of those rooms came to the same cold mathematical conclusion simultaneously. If the United States government can flip a switch and make $300 billion belonging to a sovereign nation simply stop working, then US dollar reserves are not actually reserves at all. They are a permission slip. They are money you are allowed to keep as long as Washington approves of your behavior. And the moment Washington disapproves, you have nothing. Nothing. Think about what that actually means for the architecture of global finance that has been in place since 1944. For 80 years, the entire world operated on the assumption that US dollar reserves held in US institutions and US debt instruments were the safest asset a sovereign nation could own. That was the bedrock of the entire system. The reserve currency status of the dollar rested on one foundational promise, which was that the United States would never weaponize the dollar against a holder of dollar reserves. February 28, 2022 was the day that promise died. And what replaced it, what every rational actor in global finance pivoted toward on that exact morning, is the only reserve asset on the face of this earth that no foreign government can freeze, that no Treasury Department can switch off, that no correspondent banking network can make disappear. And I think you already know what I'm talking about. What happened after February 28, 2022 is not a theory. It is not a prediction. It is not a gold bug fantasy. It is the most comprehensively documented sovereign buying spree in the entire recorded history of modern central banking. And the numbers are so dramatic that when I first reviewed the Goldman Sachs data on this, I read it twice because I assumed there was an error. Before 2022, central banks globally were buying approximately 17 tons of gold per month. 17 tons. That was the baseline, the historical norm, the number that gold analysts had built their models around for years. Beginning in 2022 and continuing without interruption, through today, that number jumped to approximately 60 tons per month, not 1760. That is not an incremental adjustment. That is not a policy tweak. That is a complete and total restructuring of how sovereign nations think about the asset that sits at the foundation of their financial security, and it represents nearly 4 times the previous buying rate, sustained over 4 consecutive years. Now, let me walk you through the specific actors, because this is where it gets instructive. The People's Bank of China has been on what is now an 18-month consecutive buying spree. They officially report holding approximately 10% of their reserves in gold. I want you to understand what the word officially means in that sentence, because here is a fact that should recalibrate your entire mental model of this situation. In the last year alone, approximately 57% of all central bank gold purchases globally were unreported. 57%. These nations are not required to disclose their purchases, and the largest non-reporter, the nation that analysts and intelligence services broadly suspect is buying at a scale dwarfing every other player, is China. They are converting the dollars they earn from selling the world its electronics, its electric vehicles, its solar panels, its manufactured goods, the massive trade surplus that flows into Beijing every single quarter. They are converting those dollars into physical gold, and they are not telling anyone. They are simply doing it. Then there is Poland, which most Western investors completely ignore, and that is a catastrophic mistake. Poland is the most aggressive publicly disclosed gold buyer in the world right now. The governor of Poland's central bank stated in January, explicitly and on the record, that he is buying gold for national security reasons. I want you to sit with that language for a moment. A central banker whose entire professional vocabulary is normally built around interest rates and inflation targets and monetary transmission mechanisms use the language of a military general to explain why he is accumulating gold. National security. Poland shares a border with Ukraine. Poland has watched from approximately 200 kilometers away what happens when dollar reserves get frozen and sanctions get deployed. They are not ideologues. They are not gold bugs. They are rational actors drawing the only rational conclusion available from the evidence directly in front of them. And then you have India, Kazakhstan, Ghana, Brazil, Indonesia, Singapore, and more than a dozen other nations all reporting net purchases. 22 central banks reported gold purchases last year. Net buying is now the rule, not the exception. This is not a fringe movement. This is the global financial system reorganizing itself around a new set of assumptions about what real safety actually looks like. Now I am going to show you something that most gold analysts either do not understand or deliberately obscure because it makes the math too uncomfortable for them to present on mainstream financial television. The supply side of this equation is not just tight. It is, for all practical purposes, broken. Here is what the above-ground gold inventory looks like right now. The total stock of gold that has ever been mined and currently exists above ground is worth approximately $29 trillion. Of that $29 trillion, roughly 20% sits inside central bank vaults. The rest is distributed across jewelry, industrial applications, private investment holdings, and institutional storage. And how much new gold enters the system each year through mining? Approximately $500 billion, worth $0.5 trillion per year against a $29 trillion total stock. That is a supply growth rate of less than 2% annually, and it does not increase meaningfully. You cannot build a bigger gold mine the way you can build a bigger semiconductor fab. The geological reality of gold mining does not respond to demand signals the way a manufacturing industry does. When demand for gold goes up, mining output does not go up proportionally, because the ore is where the ore is. The processing capacity is what the processing capacity is, and new major deposits take a decade or more from discovery to production. Now here is where the math becomes genuinely alarming. The central banks of the world, these sovereign buyers running this 60-ton per month buying program, are collectively purchasing gold at a rate that absorbs virtually the entire annual mining output of the planet. Every ounce that comes out of the ground is being consumed by sovereign buyers before it can reach any other part of the market. The institutional investors still need gold. The retail investors still need gold. The jewelry market, which represents an enormous portion of physical demand, particularly in India and China, still needs gold. The industrial applications that use gold and electronics and medical devices still need gold. All of those buyers are now competing for supply that the central banks have essentially already claimed. And here is the kicker that I need you to truly absorb. There is no Federal Reserve for gold. There is no government on earth that can authorize the printing of additional gold. There is no quantitative easing program, no emergency monetary facility, no extraordinary policy measure of any kind that can create more gold. The earth contains exactly as much gold today as it will contain in 50 years, in any time frame, relevant to you, to your children, or to your grandchildren. When you have demand growing at nearly 4 times its historical baseline, supply that is physically constrained and cannot be expanded, and a buying pool of sovereign actors who are not price sensitive because they are not buying gold to make a return. They are buying gold because the alternative is holding an asset that can be switched off by a foreign government. The trajectory of this market has only one mathematical direction. Let me take you back to 1971, because you cannot understand what is happening today without understanding what Nixon did on August 15th of that year. Before 1971, the US dollar was backed by gold. Every dollar in circulation was theoretically redeemable for a fixed quantity of gold held by the US government. That was the Bretton Woods system, and it gave the dollar its credibility as a global reserve currency. Nixon broke that link in 1971, which created an immediately problem because the dollar now had nothing behind it except the promise of the US government. And the world's oil exporters in particular were not thrilled about accepting pieces of paper backed by promises in exchange for their finite, irreplaceable natural resources. So Henry Kissinger and the Nixon administration made a deal with Saudi Arabia. And that deal was elegant in its simplicity. Saudi Arabia would price its oil exclusively in US dollars. Every nation on earth that needed oil, which was every nation on earth, would therefore need to acquire US dollars to buy it. The demand for dollars would be structurally guaranteed by the physical reality of global energy consumption. In return, the United States would guarantee Saudi Arabia's security, sell them advanced weapons, and treat the House of Saud as a protected partner. That arrangement became the petrodollar system, and it is the actual foundation upon which the dollar's reserve currency status has rested for 50 years. Not American productivity, not American military power alone, not the appeal of American democracy, but the simple mechanical fact that you need dollars to buy oil and everybody needs oil. Now, Saudi Arabia has not made any official announcement about ending the petrodollar arrangement. They are far too sophisticated for that. But Swiss industry analysts have tracked Saudi Arabia importing approximately 160 tons of gold from Switzerland over the past few years, in quantities and patterns consistent with central bank accumulation rather than jewelry manufacturing or private wealth. 160 tons. The architects of the petrodollar system are quietly, methodically converting their dollar holdings into physical gold. They are not announcing this. They are not holding press conferences. They are simply doing it the same way China is simply doing it. And the money flow tells you everything you need to know about what they actually believe about the long-term value of the system they helped build. The petrodollar is not collapsing overnight. It is not disappearing next week. But it is rotating. The dollar will remain significant. It will remain the largest single reserve currency for years to come. But its dominance, its monopoly position, its ability to function as the only game in town, it is ending, and as the petrodollar shrinks as a percentage of global reserve allocation. Something has to grow to replace it. And that something is not the euro, which has its own existential structural problems. It is not the Chinese renminbi, which is not freely convertible and which carries its own political risk. It is the one asset that has functioned as a store of value for 5,000 years, that no government can print, that no Treasury Department can freeze, and that every central bank on earth is currently racing to accumulate before the window closes. Now I'm going to tell you exactly how not to be an idiot about this, because I have watched intelligent people make catastrophically stupid decisions around gold for 30 years, and I am not going to let you add yourself to that list. The first mistake, and I hear this constantly, is people saying they missed it. Gold was at $1,800 an ounce when Russia lost those $300 billion in February 2022. It ran to nearly $3,300. It pulled back 16% from its recent highs, and I received messages from people acting as though the thesis had broken. Let me be extremely clear with you. A 16% pullback in a commodity that dropped 50% in the middle of a 2,300% rally in the 1970s is not a broken thesis. It is a bull market consolidation. It is the market shaking out weak hands before the next leg higher. When the World Gold Council surveys central banks and 95% of them say they plan to continue buying gold in 2026, and 0% say they plan to reduce holdings, the demand side of this equation is not reversing. The second mistake is the all-in crowd. And if you are in this camp, you need to hear this, even though you will not enjoy it. Gold is not a portfolio. Gold is a component of a portfolio. Most serious long-term investors operate in a range of 10 to 15% allocation to metals broadly, with gold as the core of that allocation. You can go higher if your financial situation supports it, but you must be able to hold through a 50% drawdown without being forced to sell, because this asset will test you with exactly that kind of move at some point. And if you have positioned yourself such that a 50% decline in gold represents a life-altering financial event, you have sized the position incorrectly, regardless of whether the long-term thesis is correct. Now, the third mistake is the one that is going to cost the most people the most money in this cycle, and that is failing to understand the difference between paper gold and physical gold. A gold ETF is a financial instrument. It tracks the price of gold. It is liquid. It is convenient. And it is an entirely legitimate tool if you're a trader who wants momentum, exposure to gold for a period of months. But here is what you need to understand. Central banks do not buy GLD. They buy London food delivery bars. They transport them in armored vehicles to their own sovereign vaults on their own sovereign soil. The Europeans are literally flying their gold home from New York storage right now because they want physical metal in their own vaults under their own control. That behavior is a signal. It is telling you exactly what sophisticated, well-resourced actors believe about the difference between a paper claim on gold and actual gold. If you are buying gold as insurance against dollar debasement, as a hedge against a financial system that has proven it can freeze assets with a phone call, then what you actually need is the physical thing, not a paper representation of it. Buy from reputable dealers. Buy the largest denomination you can afford because the premium per ounce decreases as the size of the piece increases. Store it properly, insure it properly, and then measure your position in ounces, not in dollars, because the dollar price is temporary noise and the ounce count is the actual position. Gold miners represent a third legitimate vehicle and a genuinely interesting one because they offer leveraged exposure to the gold price. A mining company sitting on gold reserves in the ground sees the value of those reserves increase with every dollar gold moves higher, which means the equity can outperform the metal itself in a bull market. But miners carry operational risk, management risk, political risk in the jurisdictions where they operate, and they require actual research to evaluate properly. They are not a substitute for physical metal as your insurance position. They are a separate, higher risk, higher potential return vehicle for the portion of your allocation where you are comfortable accepting that additional risk profile. The world is not ending. I want to be clear about that because the gold discussion sometimes attracts a certain variety of apocalyptic thinking that is not useful. The dollar is not going to zero next Tuesday. The banking system is not collapsing this quarter. What is happening is a rotation, a long, structural, decades-long rotation away from a unipolar dollar system toward something more multipolar, more distributed, more complicated. And in that new system, gold will occupy a larger share of global reserves than it has at any point in the last 50 years. That rotation is already underway. The central banks are not predicting it. They are executing it. They started executing it on February 28, 2022, and they have not stopped. Here is where I am going to leave you, and I want you to think very carefully about what I am about to say. On February 28, 2022, the most powerful central banks and finance ministries on earth received a demonstration of exactly how vulnerable dollar-denominated assets actually are. And their response was not to argue about it, not to write think pieces about it, not to wait for more data. They acted. Within months, gold buying quadrupled, and it has stayed at 4 times its historical baseline for 4 consecutive years. These are not emotional actors. These are institutions with armies of PhD economists and decades of institutional experience managing trillions of dollars in sovereign wealth. And they looked at that demonstration and they made a cold, rational, mathematical decision that the risk profile of dollar reserves had permanently changed. You are an individual investor with infinitely more flexibility than a central bank. You can move faster, you can allocate more nimbly, and you do not have to file public reports about what you are doing. The question I want you to sit with tonight is this. If the most sophisticated sovereign financial actors on earth looked at the current dollar system and decided they needed to restructure their reserves toward gold, what does that tell you about what you should be doing with your personal financial reserves? I am not telling you to panic. I am not telling you to liquidate everything and buy gold bars. I am telling you to do your research, make your own conclusions, and stop waiting for permission from the same financial media that has been wrong about every major macro shift of the last 20 years. The race for the world's gold is already underway. The question is not whether it is happening. The question is whether you are going to participate before the window narrows further, or whether you are going to watch from the sidelines while the most consequential monetary realignment in modern history plays out without you. That is your choice. Make it deliberately and make it now